Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. Dow Jones Industrial Average and S&P 500 indexes set record highs in the past week. In the same week, gold price slumped more than 3% to levels near $1,550 per ounce. For this week's market commentary, we are going to look at the factors depressing gold price as well as why we think the story for gold is still there, fundamentally. The precious metal fell sharply as concerns about Europe's debt eased. Moreover, gold lacked support from the US dollar as the US currency appreciated against euro. Gold continued its slide after the release of strong US factory orders, which propelled equities higher but weighed heavily on the yellow metal. These are hints of a global economic rebound which inevitably prompted investors to dump gold. However, Friday's release of non-farm payroll showed that the US economy added just 88,000 jobs, well short of economists' expectation of 190,000 jobs. For the first quarter of the year, the US economy added an average of 168,000 jobs per month. If all goes well at this rate, the US economy would get back to full employment in 2020. 2020, that is at least 7 years away, and it is reasonable to guess that they are more likely to have humps ahead than an expressway ahead. Gold is real in a world of paper promises the central banks may fail to keep. Monetary easing is currently employed by major central banks. The Fed is expanding its balance sheet at $85 billion per month, while Japan's central bank announced last week that it aims to double its monetary supply by the next year end. Interest rates in most countries are either held steady or cut in a bid to stimulate growth. Gold, which has been traditionally thought of as a hedge against rising consumer prices, may well be in demand as soon as headline inflation picks up. Investors may be losing faith in gold, but central banks have been absorbing the supply in recent years. Central banks have turned net buyers of the yellow metal in 2011, after 2 decades of consistent selling, revealed the World Gold Council. The buying trend continues in 2013, with central banks having a net purchase of more than $3 billion in gold in the first 2 months of the year, according to data compiled by UBS. South Korea is the largest net buyer, with Russia a close second. I can't help to think that South Korea may be backing its Korean won should a war rage between the North and the South. The appeal for gold is strong from a diversification point. Barclays data show that the correlation between gold and S&P 500 is 25%. This means that as equities rise 1%, gold is likely to edge higher by a mere 0.25%. When added to a portfolio of risky assets, gold may potentially lower the market risk to an investor's portfolio. Although there are signs of a stronger economic recovery, the signs are not consistent. As we enter the next earnings season, companies turning in their first quarter report cards may give a clearer indication of whether equity investors have been overly optimistic on global recovery. If it turns out to be so, gold may once again regain its glory lost since October 2012. If you are humble to admit central banks know better, there could be a real case for gold despite the heavy selling pressure which pulls gold under $1,600 per ounce. Moreover, positioning for any major political event with gold may not be a bad idea, especially when North Korea has declared a state of war with its uneasy south, and the US stands ready to provide defense assistance when required. Thank you for watching this week's Phillip Market Watch. My name is Victor Y, and we'll see you next week.